Wall Street did not like Disney's last quarterly report, as the stock has now dipped down to 160. With a great company like Disney, I think long term this company has potential, so when it dips like this, it always has my attention. A couple months ago, I did make a video about myself selling my stake in Disney, as I thought it was a little overvalued at the time, but with this new earnings, a couple months have passed. I'm going to be diving into the details of the earnings report for this video and give my updated thoughts on the valuation as well as the stock going forward. For a lot of stocks I cover, I usually have to do a background, but I think everyone at this point knows what Disney is. If you don't, you're probably living under a rock. I don't even know how it's possible. But they have a ton of different IP, and this company is a content media juggernaut. Now, just because a company is a juggernaut or an absolute beast of a company long term doesn't mean that the stock is always at an attractive valuation. And we see that this year, the stock itself has underperformed a bit, especially since the March high of around $200. It's downtrended and actually at this point is negative on the year. So are earnings really that bad to cause an 8 to 10% drop in the stock? Let's take a look. Estimates for the quarter was around 52 cents per share, and expected revenue was 18.8 billion. And the big number everyone was focused on was the subscribers, which was expected to grow at 9%, close to 126 at the end of the quarter. What ended up happening is they were less profitable, their revenues were lower, and they missed on subscriber growth. And the big thing was the subscriber growth, as that was only 2.1 million subscribers added, and the growth rate was only around 2% versus the expected 9%. The company did reiterate that they expect 230 to 260 million subscribers by the end of fiscal year 2024, which if you do the math from the 118 million, that's anywhere between 25% growth each year to 30% growth. So I understand there is fear when the reported growth is only 2%. If you look at a full year change from October 2020 to 2021, the percentage change is around 60%. And it's obvious that the market and Wall Street is fearing that the deceleration of that subscriber growth won't make it so they hit these numbers. I understand the concern from Wall Street, but I don't think it's fair to judge a company based on one quarter's numbers, because one quarter could be 40% growth, the next 2%, but over a year, they can get to the correct percentage in order to hit that compounded annual growth rate. And while there's a narrative that Disney is a growth company, the revenues year over year actually grew at a very small pace, 3%. And the reason being is the parks are still struggling. They're dealing with the pandemic still. This last quarter, they talked about how there's an increase in costs related to safety, lower capacity for parks. Back in 2019, the parks revenue was around 26 billion, whereas the past year was 16 billion. So I think it's easy to say that once they open up to full capacity again, it would make sense in my mind to get back to similar levels of revenue, which is a nice tailwind for the company, especially when the main focus right now is on subscriber growth for Disney Plus and them growing that streaming revenue, which is definitely helping offset the loss in revenue from parks. Unfortunately, that increase in costs is affecting their bottom line, and you can see their free cash flow actually is down 45% versus last year. So they're not making as much from those revenues that they're generating. What kind of sucks there is I don't think they'll be able to have the same profit margins as they did before the pandemic for a while, because there are increased costs there, and they're also putting a ton of money into creating content in order to get more subscribers and grow the streaming side of things. You're talking about $1 billion per year in additional costs for regulations and following certain safety precautions. For their direct-to-consumer segment, they did bring in more revenue, but at a higher operating loss. And they highlight the fact that Disney Plus had higher costs due to programming, production, marketing, and technology. Prior to the pandemic, they had a 21% operating margin, whereas now it's around 11.5%. So the profitability of their revenues that they're generating is going down. But it should bounce back little by little over time. To sum up the story, basically margins aren't as high and the growth isn't as high as expected. But that doesn't mean those things won't come back, and even next year. So let's go ahead and talk about the valuation and whether or not I think Disney is now an attractive buy. Here are some of the assumptions I used for a discounted cash flow model, as well as the operating margin, how much revenue I think they'll have over the next year. And then I use 10 to 8% revenue growth from 2023 to 2026. And then also an increase in operating margin to get back to somewhat closer what they used to operate. If I use a reasonable price to sales ratio of 4.25, which is a little lower than what they've been trading at, which is closer to 5, we're talking about a price per share of 157, around that 160 range, whereas the DCF is around 175. So if I combine those, you get an average that's close to around fair value of 170. If I look at something like tip ranks and what Wall Street is thinking, a lot of analysts have price targets in the 200s, lower 200s. So it's an aggregate average around 208, 30% upside. Overall, analysts and Wall Street is still very bullish on Disney. I think Disney has gotten to a point where it is pretty close to fair value. So the longer term you're thinking for the stock, this may be a good time to invest. I'm probably going to wait until it hits 145 or 150, or if it does, in order to buy it at a discount to fair value. So I know I'm getting a little greedy trying to pick up a lower cost basis, but that's just how I personally trade my portfolio. I try to buy these stalwart companies that are growing at a decent pace at a discount. That way I can hopefully add alpha to the portfolio, buying it cheaper than what it should be fairly valued. That way I'm getting the growth of the company plus it getting bounced back to its fair value. Long term, this company isn't going away. Media juggernaut. I think Disney Plus will gain those subscribers over the years, maybe not as fast as they are predicting, but I still think that is decent growth. And then the bounce back in the parks, overall bullish on the company long term. If you guys did enjoy the video, make sure to hit that like button, as well as consider subscribing to Main Street Wolf, where we talk investing, stocks, anything to do with money. Thanks guys for watching, and have a great day.